Hello, welcome back to Retirement Clarity Radio. I am your host, Scott Newhouse. I'm really excited that you are here. Today we are going to be kicking off our series on investments. And so over the next 4 to 5 weeks, 4 to 5 episodes, we're going to be talking, big picture, very broadly, things that you need to do or things that you need to consider as you come up with your investment strategy. And this is going to apply whether you're in retirement or if you're a couple years or 5 years or even a decade away from your retirement. So it's going to apply in either situation. And so we'll get into some things that you need to know in the future. Today, we're actually going to be talking about one really giant mistake that a lot of people make, especially what we've seen after the last 10 years of the stock market. And that's honestly getting too confident, getting too cocky in terms of your investments and taking on some high-risk stuff that is probably not a good idea. And I actually got this idea to talk about this via an article that I read in the Wall Street Journal by a gentleman named Dennis Neal. And so Dennis is going to take us through his thought process of what he's done with his own investment strategy, some changes that he's made to it, and how it's worked out for him. I'll give you a little hint. It has not worked out well for him at all. So this podcast, today's episode, is about things that we need to avoid doing with our investments. And then the next few weeks, we'll talk about things that you should do with your investments. But again, it's one of these things where if you can just avoid doing things that are wrong, it's going to save you so much grief, it's going to save you so much time, and it's going to save you a lot of money. So figuring out what to do, that's important, but also figuring out what not to do, that's just as valuable. Honestly, it might be more valuable, than talking about what to do. Okay, so I'm going to read some of Dennis's article, and then I'm going to interject my own commentary. I've kind of done this format before, so that's how it works, and I'll try and differentiate between what Dennis is saying and what my commentary is. So Dennis writes, the long-running bull market is a wondrous and marvelous thing. In the first quarter of 2021, Fidelity had 365,000 401k accounts with over $1 million in it, double the total from the first quarter of 2020. The higher the markets rise, the more some of us believe we are investing geniuses. I fit this diagnosis. Though I spent my career covering business news and talking about stocks on cable news, I invested almost entirely in index funds and ETFs until a few months ago. Let me stop Dennis right there. So Dennis is saying, for most of his life, he's invested almost all of his money in index funds and ETFs. That is absolutely 100% what you should be doing. And so Dennis is going to talk about how he changed from that policy, which he should not have done. But if you're in low-cost index funds, ETFs, and there are some low-cost mutual funds as well, that's exactly what you want to be doing. So Dennis continues, emboldened by the growth in my retirement account and the ease of betting 5-figure sums in seconds online. Okay, I got to stop Dennis right there. When we're investing, we're not betting, we're not gambling, we're not going to Vegas and playing blackjack. We're investing in companies that are growing over time, that are producing, services and goods that people want and buy. If you invest in Amazon, that's not a gamble, that's not a bet. You're investing in a company that is, kind of taken over the world and changed how normal everyday life is lived. So I think investing, there's a difference in my mind between betting and investing. Now, what Dennis has done, Dennis has basically been betting. But what we should do, we should invest. So I hope that differentiation is clear. So, okay, I'll read that sentence again. So Dennis says, the ease of betting 5-figure sums in seconds online, I started to make some moves. Within weeks, a cardinal lesson proved itself. Once your portfolio is set, the less you do, the better. Okay, Dennis hit it. He hit the nail on the head right there. There have been studies that demonstrate this, that when people trade more frequently, when people even check their accounts more frequently, and look, we're all guilty of this to some extent, but I've known people who check their investment accounts every single day. That is not a good use of your time. Frankly, there's not going to be changes that we're going to make every single day or even week or month or honestly even every year. Maybe you might want to rebalance, but just doing one investment strategy for 1 year and then changing it, I think that's crazy, and you should absolutely not do that. And so Dennis is absolutely right. So Dennis knows what to do, but he's going to talk in a few seconds about what he did, which is different than what he knew he should do. Okay, so again, great lesson Dennis provided us. once your investment portfolio is set, the less you do, the better. Studies have shown that if you follow that, you're going to get better returns than the people who are tweaking their portfolios more often. That's just, I don't know, it's just something you need to do. So Dennis talks about, or let's go on with Dennis's writing. So my foray into higher risk began on September 27th. He bought Alibaba at $150 a share. The stock had hit $310 a share in October of 2020 before a corporate crackdown in China pounded the share price. I had met Alibaba founder Jack Ma more than a decade ago when I worked for Forbes and we profiled him. I left that meeting impressed. 10 years after I bought in, news broke that investing legend Charlie Munger, Warren Buffett's business partner, had almost doubled his stake in Alibaba to more than $300,000 shares. The stock surged to $177 a share by October 22nd, and I was feeling cocky, up 18% in less than a month. And again, this happens to all of us. If you get lucky with your timing, which happens, and the stock market goes up, you feel like you're the smartest person in the world. You feel like you're the next Warren Buffett. Hate to break it to you, you're not. And your friend, your cousin, your whatever, who got in the market and had an 18%, 20% gain in 1 month, it's not sustainable, and they're never going to tell you about their losses when they're down 25% in a month. Now, Dennis is the exception because Dennis is really self-aware and he's a good writer. So Dennis is actually telling us about his mistakes, which we'll get to in a second. But if you're up 18% in a month, it's mostly luck. It's not skill. Okay. Back to Dennis. He writes, "Yet I refuse to sell and count my winnings, failing to heed the old saying that bulls make money and bears make money, but pigs get slaughtered. Greedy pigs get slaughtered." Okay, and then the price started to slide in mid-November. By market close on December 20th, it had plunged 35% to $115 a share. Alibaba's CFO resigned, and the company cut its growth projections and reorganized its corporate structure. Yet I lacked the conviction to buy more. I am down more than 20% in less than 3 months. And Alibaba's gone up a couple dollars a share since Dennis wrote this article, but it's not much. So yeah, he's probably still close to down 20%, maybe 18%. I don't know the exact numbers. Anyways, I don't think I need to read the rest of this article to you. I can do a little summary of what Dennis did. But basically, he bought maybe 4 or 5 more single stocks, high risk, high reward stocks, and he's had some really poor returns. So he bought a Bitcoin's future fund that basically follows Bitcoin's price. And I think he bought that in November. And when he bought it, the price was $40 a share. And now he writes it's under $30 a share. And I think I checked this right before I started recording. I think it's at $26 a share. So he bought it 40 and now it's at 26 in just about 2 months. And then he also bought Tesla, and he bought Tesla at $1,186 a share. And now, at least of the writing, Tesla was under $900 a share. And I think when I checked it this morning, it was around $875 a share. So he writes, my wager is down 25% in 6 weeks. So I hope you guys are getting the trend. 2 more, because these are honestly the worst ones. He bought another Bitcoin fund, and that... Let's see, I think I have it pulled up right here. Yeah, I think he bought this in December of 2021, and it's down, I don't know the exact price he bought it, but it's down at least, 15 up to 20% down from the time that he bought that. And then he also bought another Bird Global stock. It's basically an electric scooter stock, and I think that, if I got his dates right, December 16th is when he bought these shares. Maybe he bought it around $7 a share on December 16th, 2021. Right now, as I record this video, it's around $3.24 a share. So, boy, his investment's basically been cut in half in 6 weeks. So, not great. So, basically, Dennis has Alibaba down around 20%, Tesla down 25%, a couple Bitcoin funds down between 20 and 25%, and some electric scooter company, and that's down. Excuse me, that's down around 50%. So this all came up, and then let's kind of wrap up what happened. So Dennis is a really smart guy, no insult to Dennis, And honestly, he's probably ahead of us in terms of admitting his mistakes and doing it publicly. So actually a lot of credit to Dennis for doing this. We all make human mistakes and emotional mistakes, but Dennis knew what he needed to do, which was to invest, as he says in the article. He should have invested and kept his money in low-cost index funds and ETFs, and I would throw in low-cost mutual funds as well. Mutual funds tend to be a little bit more expensive than ETFs, but you can find some lower-cost mutual funds. But basically, he knows what he should have done. Low-cost investments that are broadly diversified. It's exactly what I do. It's what my clients do. It's what you should do. Everyone should do it. And, if you want to put couple bucks, maybe a share or two in single stocks, and it's not going to mess up your retirement plan, fine. I don't recommend it, but if you can see that $1,000 you put in go to zero, I guess fine, you can do it. But that's betting, as he talked about here. And so Dennis talks about how he went into single stocks and he thought this was betting. And he thought that since the stock market's gone up so much, especially the last 3 years, the last 10 years, he thought he could pick single stocks that would outperform what the market's done. And so that has not been the case. The S&P 500, which is, basically tracking the 500 largest companies in the U.S., it is down around, let me see if I can find this right here. It's down around 5 to 6%. The stock market's changing, every second, of course. But the S&P 500 in the U.S., tracking 500 U.S. Stocks, is down around 5 to 6% in the last 3 months. As we have gone through with Dennis's single stock picks, he's down anywhere from 15 to 25, all the way down to 50% in his single stocks. So he's lost much, much more than what he would have done. Excuse me, let me get some water. So he's down much more than what he would have been down had he just kept into those low-cost index funds and be broadly diversified. So that is what I have for today. As you guys go into retirement, even if you're in retirement, I really got to urge you, you've got to stay true to a tried and true strategy, which is low-cost, well-diversified investments, and have like 99% of your money in there. And if that remaining 1%, if you've got this itch, and I've had clients come to me and say this, they say, Scott, I've got to put 500 in Bitcoin. I've got to put 500 in this single stock. I know it may not pay off, but I just want to see what's going to happen. I want to take a little risk. And for those clients, again, if they've got 99% of their other money in low-cost, well-diversified stuff, and they say, I want to invest, $500, $1,000 into a single stock, well, fine. But you've got to be prepared for it to go down. But overall, almost all of your money, and I honestly wish it was all of your money, would be in those low-cost, well-diversified funds, as we have seen from Mr. Neal detailing his terrible investment returns over the last 3 months. So that's all I've got for today. I hope you found it useful. Again, this is something we should absolutely avoid. Don't get confident, overconfident. Don't get cocky in terms of your investments. Stick to those tried and true low-cost, well-diversified strategies that we're going to talk about on this podcast, especially in the next few weeks. So that's all I've got for today. Hope you all have a great week. Bye. Thanks again for listening. As a reminder, you should consult with a financial advisor familiar with the specific circumstances of your unique financial situation before making any financial decisions. Nothing in this podcast is a solicitation for the sale or purchase of any securities. Any mentions of rate of return are hypothetical in nature and not a guarantee of future returns. Scott Newhouse, CFP, is an investment advisor representative of Forthright Finances, a California and Nevada registered investment advisor.